Hello, Jim Ellis here from schooldesign.com, and if you're watching this video, you're probably an international schools teacher looking to learn a little bit about some of our financial options. Okay, and with that, with our financial options, how we deal with things in the international world, a lot of it's the same that you would see back home in the US or wherever you're from. Specifically, I'm speaking as an American, and American finances, kind of how they work. So I'm going to just kind of cover some brief ideas in this video. If you want to know more, we should get together in a webinar or a seminar, some space like that where we can talk a little bit more. I'm not a professional at this stuff. I'm a math teacher and a blogger and a designer, not a professional. So this should be anything that you see today or in person with me should be considered a conversation from colleague to colleague. Probably the three most important things that I think about with my money relate back to retirement. But are these three main ideas. How much do I need to save each month? How do I save that money well, or to get the greatest growth out of it, the smartest growth out of it? And then how do I take that money out when I retire? And these three questions will guide us through today's video. How are my finances looking right now? These are the things I'm asking the most in regards to this. Debt is probably the main one. What is the nature of my debt? How does it affect my life right now and my ability to save? And not all debt is created equal. But most importantly, you want to think about working down your debt as quickly as possible, starting with the things with the highest interest rate and paying ahead on those when you can. And then prioritizing down to the lowest interest rate. Different than that can be certain debts that are investments that can be sold, like a home, for example. So you might think of that as a debt, but it's also part of your net worth. It's part of your investment strategy. These properties, a home that you own, land, something like that, an apartment somewhere. These things are not going to be categorized as debt necessarily. So let's think specifically about things that, you might have, like a car loan or college tuition payments, an education loan that you might have. So let's think about those first as the debts that you want to work down. Credit cards can also be in that as well. These are all things that you want to get as low as possible. Credit cards might be the highest interest rate. You need to look very carefully at these things, evaluate your debts and rank them. But if you have credit card debt, that's something you're almost certainly going to want to get down as quickly as possible. And then look at the next thing and work them down as much as you can, paying ahead of schedule, and picking an end date when you can get this loan done or credit card payment, whatever it might be. And getting it off of your books. That way you can take full advantage of your ability to save today. All right, now when thinking about how much you're worth at this point, you might have heard of something called net worth. It has a little bit to do with the debt that we were talking about. You're going to want to look at all the investments that you have, or the property value that you have that's above the loan that you own, or other large things that you can sell for money today. And that's going to become your net worth. That net worth is something that you will still need to subtract out your debts. So you're going to take the value of everything that you have now and subtract out your debts, and that's going to be what your current net value is, your net worth. Don't get too scared by that number. It's a starting place for you to consider, should anything happen to you today, or should you want to choose to quit working for any reason, this is what you have today. And we want to look about building forward into the future. So we don't want to get sad about where we are now. We want to get hopeful about where we're going. But it's kind of an interesting number to know or to think about in terms of what is the money that you've made so far in your career, and where's it going? Okay, investing money. So we have a starting space now. We kind of know about our debts, and we know a little bit about our net worth, hopefully, that you've calculated already. And now let's talk about building and growing from there. And so first we need to sort of understand what it even looks like to invest. Think of the jar in this analogy right here as the account type that you have. Maybe you have a Roth IRA, maybe you have a brokerage account, maybe you have none of these, you just have a checking account. The jar for this instance here is going to be our investment account, and there's lots of types. And so once you've chosen one, or you're looking at choosing one right now, there are things that go inside of that jar that become your assets. You could buy gold, you could buy pork futures, you could buy mutual funds or index funds. All of these would be inside of your account. So the account type means how you're going to be taxed in America, some rules about how much you can put into that account type, how much you can take out, at what age. But it isn't the actual asset that you have on the inside. So the account type is sort of governing your usage of your money from here on out. And so you want to pick an account type that meets your needs. And inside the jar, the assets that go inside of each account type can be interchangeable. You can get a mutual fund for a brokerage account. You can get a mutual fund for your Roth IRA. You can get a mutual fund for your IRA. It really doesn't matter. Once you have an investment account, you can put whatever you want inside of that account. And that's where you start working the most with your financial advisor. Okay, so that's the types. Now, what might be the most important thing for an international teacher to consider, or a teacher in the US, or really just anyone who is saving towards their retirement, that is a function of something that they need to do. Fees would probably be the most important thing to consider. The higher of the fees that you're going to pay, the less money you're going to make. And it doesn't sound like it makes much sense if your financial advisor is telling you that they've reduced their fees from 1% down to 0.5%. That might just sound okay, but that is an enormous amount of money that you're going to make across time through this thing called compounding interest. If you want to know more about compounding interest, you can stop by my 7th grade math classroom. I'm happy to show you how it works. It's in my lessons in the springtime. There's also tons of videos about it online, but yeah, you might want to look that up, compound interest. And that is the mathematics that govern why fees are such a big deal for you. The smaller the fees you can make the product that you purchase, the more growth you can make. And financial advisors are really good at selling to you products with high fees to express that they know how to make it grow faster, that they can overcome the deficit that the fee is going to bring you. Generally speaking, that's not very true. Index funds that are unmanaged, we'll get into a little bit later, they outperform managed funds 80% of the time. So for an advisor to tell you that they can, with certainty, grow your money faster than the fees are accumulating, generally isn't true. That doesn't mean that you don't want to select those for certain reasons, or invest some or all of your money with an investor, investment professional, or advisor professional. But you need to be very considerate of what those fees are that they're asking you to pay, and knowing that it is a fee and that you're buying a product from them, and that you can ask for some leverage on some of those fees that they can reduce, or ask them to look for, that would be like on the account type and what they're going to charge you for that account type. And you're also free to ask them to find assets for you that have the lowest amount of fees possible with the highest amount of growth potential as a strategy. So I highly recommend understanding the fees that you're paying and reducing them as quickly as possible. With managed funds, having a financial advisor who's taking care of your money, any of the big firms do a managed style account. If you have a number you can call in an office and they know your account name and number, that's a managed fund, and they have all sorts of fees for you to pay them. They seem really small, But again, going back to the magic of compound interest, you want to work those down as much as possible. So you could be paying any one of these things, and you can, I think there should be a link to this slideshow down here. You can see this more clearly later. You want to ask about these fees, and you want to know what you're being charged, and you need to measure whether or not it's worth having a managed fund that's going to make you pay these fees. And it might be worth it, but it might not be. So these are many of the fee types that you can pay. Some are percentages, some are flat fees, like a $10 or euro transaction fee, or a 0.5% brokerage fee on a mutual fund that you're paying. One thing might be negligible and be fine for you. Another thing could mean thousands and thousands of dollars down the road when you want to take your money out. And that gets to this big idea about managed versus unmanaged funds or accounts. A managed account, again, means that you have a phone number you can call. A guy or a gal meets with you, sits down across from you, and does a little bit of planning every year, and then they disappear, and you don't see them or hear from them again. They just put your money into certain places and take a fee for that. There is a great reason to have managed funds. If you know nothing about the financial world, you might need it, and some advice. And if you're going to pay for that advice, use all of their services fully and learn as much as you can from it as possible. Meet with them regularly, ask a lot of good questions, get their tax help that they're going to provide you. Most do at this point offer sort of things to the side of the actual investment account that you have with them and the assets that you have with them. And tax help can be certainly one of those things. Sometimes they can help you transfer money through currencies, these sorts of things. So if you choose a managed fund, you're going to pay quite a bit for it, of future earnings. Even 1% is a lot of money. So if they say 1% or 0.5%, that's a tremendous amount of money when you're done with your investments to have paid them. So you want to take full advantage of the services, of the thousands and thousands of dollars or euros of future growth that you've paid to them as a result. Unmanaged means you're doing it yourself, but the fees are dramatically reduced. So how do you do that as a teacher or someone who's not a financial professional? The best way to have an unmanaged future retirement is for you to pick a clear and simple strategy and stick to it. And then use internet resources or one-time consulting fees with a financial advisor who will charge you $100 or $200 for an hour, and then you're done with them permanently. And then you write down all that advice and you follow it to have a really simple and clear strategy about what you're going to do and how you're going to do that thing. And through that hour, you might be able to get a really good sense as to how much you need to save each month, what you can expect when you're at retirement age, or if you can retire early, when would that be and what would your retirement look like. Some of that planning that a managed account can do is something you can do yourself, by yourself, just using tools on the internet, chatting with colleagues like me who know a little bit, and also paying a professional an hourly rate, and then for them to go away at that point, to not continue drawing money from your account. So you can get financial help on the managed side, where they will continue to take your money continuously forever in perpetuity. Or you can pay a professional a 1 or 2 time fee for meeting with them once or twice, and then they won't ever draw money off of your accounts. So, but that 1 or 2 time thing won't help you transfer money. It won't help you with taxes. You would then have to go to a tax professional for that help. So you've really got to ask yourself, what are the services that I'm being offered, and how regularly am I going to take advantage of those services to choose managed? And if you want unmanaged, you need to also consider what is that going to look like in terms of how much am I going to need to pay to get enough help to manage my accounts myself, to have that simple strategy that is going to be successful. One really nice way to understand the difference between managed and unmanaged is to run your numbers from your accounts. How much do you have now in a calculator like this? I'll put a link here. How much money do you have now? How much do you anticipate saving each month? And then let's put into the percent per year. Let's put in 7% for the unmanaged account. We can pretty much say that across the lifetime of your accounts, 20, 30, 40 years, you're going to hit that 7%. Then, if we include the management fees, which can be more than 2%, sometimes less, but let's put in 2% right now. And let's look at the difference between the two accounts. Unmanaged 7%, you can grow, according to this calculation on this internet calculator, over $800,000. If you start with $10,000 right now, $10,000 in the account, and you add $1,000 a month, you can, in 25 years have more than $800,000. About $200,000 less than that is where you would be with a managed account. So for all the advantages that a managed account might have, those fees that are stacking up with it, that they're pushing you into mutual funds, and that they're other managed assets, and that they're going to take fees for management. There's a large gap there, and that $200,000 could be the difference between a comfortable living in retirement that continues to grow slowly while you're retiring and as you're slowly drawing it out, or the difference between not having quite enough to do some of the things that you would like to do. So strategizing to reduce your fees either with your advisor or by doing it on your own, and watching that 7%, how close to 7% a year and how close to fee-free investment can you get, is probably your greatest strategy that you can accomplish with your assets, is setting them to grow as much as possible while paying the least amount for that. And these two windows, the only difference between them is that one person was earning 5% a year because they were paying a lot of fees, and the other person was paying close to no fees and earning about a full 7% a year. And that is a tremendous difference, as you can see here. So that 7% that I showed in the last screen, the biggest idea coming out of that is that you could invest in something called an index fund or an ETF. These are unmanaged assets. Your managed account and your managed broker that already has a fee on top of it, they can buy these. And it's a great investment across time. You buy it and you sit on it and you never touch it for the next 20 years, next 30 years, next 40 years, however long you have to let it grow. If you have a self-managed account with a firm like Vanguard, but there are many others, you can buy this asset and have really close to that 7%, because now you're not paying for the management on the account or the jar, and you're not paying for the asset to be managed. An index fund is designed to grow with the market. If the market goes up, the asset goes up, the index fund goes up. If the market goes down, it goes down. But luckily, we're using the law of compounding interest and the fact that markets grow across time. They have for the last 100 years. That's the hope that for the next 100 years, markets will continue to grow. And therefore, you can bank on that growth and skip the fees. And so that's what an index fund or an ETF is designed to do. A lot of people who manage their own money, they are primarily in ETFs. Maybe they are hedging their bets a little bit with something called a bond, or they're buying gold on paper or actual gold bars and sticking them under their bed or something. And those things are different, but also unmanaged and also fee-free, but they don't necessarily have the same growth potential as the whole market as a broad category. So an index fund is low fees, tracks the market broadly, and moves up and down with the market. And across time, your expectation is that it will grow with having paid very little to do so. That's the main idea behind an index fund or an ETF, and it is a major feature of the investment world today. It's a really good bet to have some of this in your portfolio, if not nearly all of it. Now we get to the part where we are international, and if you want these index funds and you want a brokerage account or a Roth IRA or these sorts of things, they get tricky. I'd read through this advice a little bit, but it is definitely the hardest part of this whole process, is to be completely legal with the American government as an American abroad, yet having an unmanaged account somewhere and being able to buy index funds. To do it completely legally is hard, and I want you to consult a professional, but I've learned a few things that might help out. Having started accounts in the United States while living there is your absolute best bet. So if you're going to repatriate to the US, learn about everything that you can and set it up as soon as you get home back to the United States. If you then move abroad again or leave the country, those accounts remain legal. They remain a piece of your investment strategy, and you can follow the guidance of that account and contribute money in most cases. I don't know of any off the top of my head where you would not be allowed to contribute money any longer. So you've really got to think about that a lot. Also, many of my colleagues that I've helped out with this, they have accounts in many different countries. They were recently in 2 different countries, and they have another one in America, and now they've joined my faculty with me in Vienna, Austria. And they're potentially having 3 or 4 different advisors with 3 or 4 different investment accounts. Some people haven't even finished cleaning out their checking or savings in other countries, and the total amount of accounts where their money is spread out could be as many as 3 in America, 3 in their new country, 2 or 3 in these other countries, making as many as 10 accounts. So simplifying it is a big deal. Figuring out where you're going to pay the least amount of fees, which advisor is going to meet your needs the best, and what opportunities do you have from your current employer to invest? Are they going to make you invest with a certain advisor and these sorts of things? There's a lot of questions about how to reduce all of that down to a smaller number of accounts as an international person moving around a lot. But it's important work that you've got to do. And so you want to stick to what are your options now? What can you do with the money to maximize it? And where are you going to pay the lowest fees? For many people, that answer is a mixture of things. A few accounts in the current country that they're in, and a few accounts in America that they had previously set up. And then figuring out a strategy about balancing those 2 things is an important thing for them to do. Generally speaking, though, you want to get everything into the place where you plan on retiring. If that's in America, go do that. Get all your money back in America. If you know you're going to be in another country for the remainder of your life, then you can look at more of a mix of things and understand that let's say live in Europe. You're going to have to move your money from America to Europe sort of on a schedule. And it's certainly easily done to say that you're going to pull out a lump amount twice a year in retirement, and then you'll pay the fees to transfer it to the currency where you're living from dollars to euros. And to sort of estimate that that's going to be a piece of the costs that you have. Okay, just very briefly, property. Property is an important topic to consider. It's a great investment when you can use it as a hedge against the growth that you want to do. But there's a lot of fees involved. So just like an index fund or an ETF that I might recommend, I would also recommend investing in property, but you have to think long-term with both. You don't buy an ETF or an index fund for 2 years. You buy it for 20 or 30 years. And you don't buy property to sell it again in a couple of years. The fees that are associated with buying and selling properties and moving in, moving out, and refurbishing, they're incredibly high. So for me, I would think with at least a window of 10 years, and can you afford it in your investment strategy for the next 10 years? And what work on that property are you anticipating? Are there management fees from a property manager that you're going to need to get? Yard work fees, property tax annually? What are the fees associated with the property that you have? And are the fees outpacing the growth of the investment itself? So are you paying, $5,000 or $6,000 a year to hold on to this property, while you think it's only growing about that same amount in value each year? Then it's a wash. But if you think you're making more than that on the property each year, that it's growing in value more regularly beyond the fees, then it's worth it. If it's growing less than the fees, now you're in trouble and you need to think about getting rid of it. But generally speaking, I would recommend working in a property that fits your needs into your strategy, your long-term, more than 10 years strategy. Thinking less than 10 years can cause you a lot of pain. Also, think about the country that you're buying it in. What are the fees in the country you're buying a piece of property in, and what are they going to expect of you? And that's a big deal. So sometimes property taxes are paid up front. Sometimes they're paid annually. That's a huge difference, and they're worth knowing about before you sign on the dotted line. How can you retire comfortably? With answering a few questions about what that's going to look like for you, you can make a pretty clear, rational decision. And they're right here on the screen. What are the debts that you have right now? What is your current net worth and value? Housing costs. What healthcare costs do you expect to have to pay for? And do you have dependents? Do you still have kids in college? Do you have a spouse that you're going to need to support? Once you've dealt with some of these questions, you can look at what your savings are at this point, your net worth, and ask yourself, can I pull off enough money from this account to pay for my life in retirement? And how long will that last? Will it last 40 years? Or do you have a strategy to keep the principal amount that you have in your account always, and that you're just living off of the interest, that you're never actually dipping into the current value of that account? So I tried to look at these main factors for myself and ask myself, at what point do I expect to be able to answer these things in a certain way where I know that I'm going to be able to retire well? And I try to actually plan that out. When is the first date where I would expect that my debts are basically gone? I know what my health insurance is going to look like and my dependents, and where are my investments at that point? Or where would I expect them to be in 10 years or 20 years or 30 years? And I can sort of circle a date on a calendar and say, this is my plan. These are the realities that will be a part of my life by this date that I anticipate into the future, and this is the anticipated growth that I'll have. And this is that intersection where I can say there's enough taken care of in my life, and my investments should have grown by this point enough. This is when I think I can retire safely. Probably the safest way to retire with a peace of mind is to say that your accounts have grown enough that if you only lived off of the expected interest every year, let's say 7% a year of the current value of your account right now, and that 7% is something that will take care of your needs. It'll take care of your health care and housing costs, any remaining debts you have, any dependents, all that stuff. That 7% will take care of it and provide me the life that I'm looking for. If you've hit that target, it's an incredibly safe place to retire, because in theory, your account will be able to handle 7% being taken off of it and never fully be reduced, because the growth will always be there for that 7% you're making back. So if my account, it has $1 million in it right now, 7% is $70,000 per year. So while some years of the market will be 14% and I'll make $140,000 a year, and some years will be 3%, meaning a lot less, 30,000 a year. The average would be somewhere around 7% or 70,000. And so if I only aimed to need to spend my interest, or that 7%, my money should never really sink out of that account down much at all. In fact, it could even continue to grow if I somehow spend a little bit less than that 7%, and I'm withdrawing a little bit less than that 7%. Therefore, I can live the life that I want with that 70,000 a year, pay taxes for it, for the capital gains in the United States, and still have enough to do the things I want, to take the trips I want, to buy the books I want, to do the things I want to do with my day-to-day life. So if I arrive at a time when the expected interest, the 7% coming off of my accounts, is enough for me to live off of in perpetuity, that's the date that I can retire. And when I know I've arrived there, I can then make the decision to either keep working because I want to, or to retire with a peace of mind. So having no or low fees, doing self-management with my accounts, to have an ETF or an index fund as my main source of income, knowing that my expected growth is that full 7%, and then asking myself, is the 7% something I can live off of right now? Then my retirement is secure on that date. Some people may not feel good enough to do that, be willing to risk it all on just a thin enough margin to say 7% will just do it for them. So they might want to work beyond that time. Maybe they're already 65, so they want to do some small part-time stuff for something out of the field of education or some tutoring, just to sort of buffer that zone to not have to take much money out at first to continue letting it grow. Or some people want to go way beyond that. Maybe they want to live big and that 7% needs to be a gigantic number in their retirement. And so they're going to plan to be way beyond that point, to take the greatest Viking cruise trips ever and golf every day or whatever it is. I don't know. So you've got a target for yourself. What do you want in retirement? How much money do you think you'll need? Then subtract the taxes out of it that you're going to pay. And make sure that you have a secure plan for that money to be there, more or less forever. We can't really say how long we're going to live, if it's 10 years after retirement or 50 years. We want to know that the funds are available for us to do the things that we wish to do with our well-earned retirement. That's it for this video. I hope it was beneficial to some degree and you've got something to argue with me about that you disagree with, or a new idea, or you just want to come and talk with me and keep going on this topic. But I think retirement is one of the scariest things we think about as teachers. It's not part of our daily lives, but it's something that deserves some attention. So I hope that we've all learned something together today. Have a great day.